What's up guys, Americana back with another video. In this one we're going to be talking about a very important topic, and that is credit. Not talking about your personal credit, not talking about your credit score. I'm talking about the credit system and the cycles that happen within it. As always, we're going to tie this back in with crypto and what this means for your bags. So let's dive in. Alright guys, I have been starting this video with a disclaimer in each and every one. These videos are a little bit different than what we typically talk about. We typically don't go this macro econ on these videos, but I've been making some claims. We've been talking about things that are completely different when it comes to the Bitcoin cycle. We've talked about Bitcoin dominance having lost all momentum on the monthly time frame. Why is that going into a bear market? We've talked about ETH BTC gaining momentum on the monthly time frame. Why is that happening going into a bear market? We've talked about others priced in Bitcoin, doing the same exact thing, gaining momentum. Why is that happening going into a bear market? We've had all these questions. And I think the macro picture, the credit cycle specifically, can do a very good job of answering those. So in this video, we're going to talk about a few things. We're going to talk about some stuff that we're seeing in the credit market, how this is completely different. This stuff is hard to ignore. This is completely outside of crypto, but crypto has a lot to do with it. Credit is essentially money. Credit is money. If you guys haven't read the book, Debt, the First 5,000 Years, it is an absolutely phenomenal read. It should make you want to buy even more Bitcoin, in my opinion. But nonetheless, it talks about credit. It talks about credit as a form of money. Credit is money. If I owe you money, that's as good as you having money. All right. And the credit system we have today, our entire liquidity and foundation is built around this credit. Each of these videos this week does tie back into credit. So we talk about the overall health of the economy. We tie that into credit. We talk about the Fed having to cut rates, having and will cut rates, and probably cut rates maybe even more dramatically than people even think. We tie that into credit as well. And in this one, we're just going to be talking about the credit cycle itself, diving into these charts, showing you what's what, how it differs from previous bear markets to what people are calling in this bear market. I also want to give the disclaimer. I don't care about Bitcoin's price. I don't care about altcoins price. I don't care about Ethereum's price. I don't care about any of this stuff. When these dynamics are at play, when the trillions of dollars that's in the debt market and credit markets, these are bigger. You don't aggregate into one asset, so you can't look at it and be like a market cap of debt is bigger than gold. But just think about how much debt there is in the world. All of that is credit. The US alone is what, like $34 trillion. Banks are in debt, corporations are in debt, people are in debt. Other countries are in debt. The debt market is the biggest market in the world. So when credit and these things are showing us certain signs, like, you physically cannot ignore it. You physically would be an idiot to ignore it. And we'll talk about it in this video. This isn't something that applies to the stock market and I transpose it onto crypto. This applies to any and all markets at all. And I feel like in this video, we are going to do a good job of showing that. So make sure you stick around. Make sure you watch my other videos this week. And hopefully this can alleviate some of the stress, some of the pain, people calling for bear markets, people calling for this, people calling for that. Just keep in mind, it also ties into some of the other things that we talked about in past videos over the last few weeks. Like I said, Bitcoin dominance, Ethereum priced in Bitcoin, others BTC, Bitcoin's Bollinger Bands being in a low volatility regime, that stuff constricting as well. This is going to be the secret sauce on the whole thing, in my opinion. So I'm excited to get some feedback from you guys. Let me know what you think in the comments. If you think this is bogus, go ahead, that's fine. But I'm betting my money on this. I am, placing my chips down on the table based on this information. So, I'm either, I mentioned in another video, I'm going down as a legend, or in infamy, I guess. And it's either going to be the dude who screamed bull market the entire bear market down, or the dude who, in the depths of despair and what people thought was a bear market, was adding to his bags and buying more because he had the secret sauce. It's not going to be an in-between. It is what it is. We'll see how it plays out. But anyways, let's go ahead and dive into the video. All right, guys, we have covered this in every single video this week. This is HYG. So this is high yield corporate credit bonds. Now, if you guys don't know how this works, I suppose I probably could have done a better job of explaining it in other videos, but it works similar to normal bonds. So when this is catching a bid, that means there's demand for these bonds. When there's demand for a bond, that means the yield for that bond is going to shrink. Eventually, that yield shrinks so much that the juice is no longer worth the squeeze, or it becomes too risky in the current environment. You'll see that stuff sell off, those yields will spike, and eventually they will attract investors again. I know a lot of people talk about the 10-year yield, 30-year yield, things like that, and those are important. But when it comes to looking at the actual risk-on environment of the financial industry, of stock indices, and all of these extremely liquid assets, stuff like Bitcoin, that requires massive amounts of liquidity, I do think the corporate bond market is going to give us better insight. So again, HYG, I figured let's go ahead and just cover what's happened in past bear markets. Where have we been in past bear markets? Everybody's pointing to being in this kind of January of 22 fractal. I simply do not see it coming from the corporate credit market. We had a crossover on the monthly time frame into the negative momentum. Just looking at the price action of this, you can see very, very, very clearly this was rolling over at the time, right into these peaks. This was gaining. If I put the peak on here, back in 2018, move over one. Yo, whoever suggested that I get the quiet mouse, thank you. I hope you watch this week's videos and just know that you're the GOAT, because this is going to come out way better. I was having this. I'm sure that's really annoying to hear. I don't know why I didn't think about that. So you're the GOAT. Appreciate you, my guy. But you can see, into these peaks, we have corporate credit rising. If you guys don't know, credit's going to sniff this stuff out first. Credit is always going to sniff out the bullshit. So you can even see, I guess we could say, we had our first kind of lower candle, into this moment, which was the kind of blow off, like insane top of the market. We had, sorry, that was of the entire bear market. So if we go to this cycle as well, this is kind of our first lower low in corporate credit, and it was into the peak. But you can really see it show up once we've kind of really got into these bear markets, which is what I'm trying to show here. And I'm trying to do it from an anchored point on my momentum indicator. That first red cross on there is going to mark when things have gotten really, really poor on monthly momentum out of the credit market. And these things continue to roll over, right? These things continue to roll over. Obviously, we had COVID come into play, which kind of threw a wrench in there. But these things also work both ways. If I go ahead and throw when we found our more macro bottoms on these charts, right? I'll count COVID as well. All right, when I throw our more macro bottoms on these charts, what does this time up with? Well, duh, it's going to be bottoms in the crypto market, bottoms in the equity market. When you get massive bids on these types of financial products, it's going to time up with these bottoms. Okay, COVID obviously being a bottom, and then also in here didn't really time up with a bottom, but timed up when that kind of fun part of the market. Everybody talks about March of 2024 into that move. Like a lot of people talk about that, and that being the best time of the crypto market thus far. Well, what happened before then? Corporate credit caught a bid. So this stuff is super important. Right now, we're looking at it through the context, through the lens of kind of macro bear market. And you can just see, even just looking at price action, right? Great up close candle to end the month right there. Nothing worrying on the monthly time frame. If we were in a similar spot like this January of 2022, we would have already seen this crossover. And we've seen that cycle after cycle after cycle after cycle after cycle. I want to zoom in here. Or actually, I don't need to zoom in. But one thing I do want to point out is you do see, kind of fading momentum beforehand, right? Into the peak, we've already had momentum fade, which is, you can kind of see up here. It's when it really starts rolling over on the price action side of things that things start going poor. And you can see that as well. Let me bring up this as well. This is going to be rate of change. Rate of change out of this corporate bond market or corporate bond ETF. But when you see this thing really start declining, right, you see this thing get under the zero line, meaning there is negative growth, this thing has started rolling over. That has been tough times in the market. If we look at Bitcoin and when we were able to actually get back above this negative growth, market was finding a bottom, Bitcoin had found a bottom, things were starting to turn back up. And if we look at where we're at currently, This thing looking pretty damn good. Make sure you check out my other videos this week because this does relate back to what the credit market is pricing in from the Fed, honestly anticipating more liquidity in the market, or this would not be increasing, in my opinion. So we also have some other charts to look at as well when it comes to this. This is that same HYG chart, but it's HYG to IEI. IEI is going to track your more traditional debts, credit markets. So that's going to be like your what am I trying to say? Like US debt, like treasuries, bonds, all those things, right? And I'm not typically a fan of trend lines. You guys should know that by now. But when we're talking about trillion-dollar assets like this, that move rather slowly and methodically, I did find it fitting, at least from a visualization perspective, to see what we could be looking at. But again, so this is high yield. Hopefully you guys, can you guys see that? I'll bring it over here. So this is high yield corporate credit priced, and we'll just call it traditional credit. So again, it is a ratio. So as the high yield credit becomes more in demand, whether this stays flat or goes down, what I'm pointing to is as this chart goes up, it is an indication that people are taking more risk. There's more liquidity in the system. Creditors are willing to take more risk on the type of credit that they're willing to purchase. And we can see that again reflected in the charts here, similar to the HYG chart that we looked at. But you can see this entire run up, right? This entire run up from bottom to peak, right? Bottom to the peak here is Bitcoin finding a bottom, getting ready to break out. You see this kind of sideways movement in here. Again, credit's going to sniff things out early. And then you see once this thing has kind of capitulated, right, it started to roll over. And that's when we've, had death and despair in the market and things like that. Okay. I do prefer the HYG chart for my momentum indicator, but I think this one is super important to kind of visualize what's going on. But zooming in, we can still see some pretty good things, right? It doesn't line up as well with these crosses. These crosses have actually kind of marked bottoms, which is a little bit interesting. Maybe something we come back to when we get there, but I do want to, I can go ahead and make this big. We already had this monthly close, and we actually had an up close candle on this move, right? Signaling that HYG is probably going to be outperforming IEI, meaning, I almost said IE, but meaning that corporate credit, high yield corporate credit, the riskier credit is going to start outperforming that more traditional credit. And we can also see this reflected on the weekly time frame where we have some kind of nice sideways movement, good wick on this candle, and good momentum to go with it as well. I don't think we need some sort of insane move. I'm not saying this thing needs to moon or even break out of the range that it's in, but we just need to see a little bit of movement up here, a little bit of chop potentially, and we will definitely be eyeing for when this thing does end up rolling over. We'll definitely be looking out for it because it's likely going to coincide if we got a move like that. I forgot to mention Russell 2000 in orange, Dow Jones in green, but likely going to coincide with some sort of top here. Correction starts to come in. I'm sure at that time people will be screaming, "This isn't a bear market. This isn't a bear market. This isn't a bear market. This isn't a bear market." Fair point, similar to what I'm doing now. But at that point in time, that's when I'll be screaming, "Hey guys, let's actually look. Corporate credit has started to roll over." Even on the price side of things, as you can see, start to roll over, has coincided with the tops in the market. We start to roll over in here, coinciding top in the market. Again, that HYG chart alone is a little bit cleaner. Is probably what we would be looking at, but we will definitely kind of reference back to this. And I thought this was kind of a cool ratio to take a look at. So I definitely wanted to show it to you guys. The rate of change on this one is pretty clean as well. I can go ahead and remove this here. Go ahead and drop this down. But the rate of change is pretty clean on here as well. When you see this negative rate of change, not a great time to be in the market, not a great time to be in the crypto market when things go negative, kind of for the first time in here, right? All the way till we get back positive in here. These are the fun times in the market. These are the really, really fun times in the market. Same thing here. We went negative in kind of that January of 2021 area. We've been kind of dicking around with negatives and stuff like that. But I think, if we look here, all right, one thing that's kind of interesting, since we've bottomed, we've had this disconnect. We've had this disconnect with equities moving higher, crypto lower, while our risk on signals fire. So to me, massive mispricing, massive asymmetric opportunity in the crypto market right now. I feel like this is pretty high level. I feel like this is pretty data backed. This is not just some fucking retard. God, I'm gonna have to edit that out. It's not some silly person just saying this and dropping some narrative or something like that. This is real data, guys. This is real stuff pointing to this. This is what I use. This is what I'm going to be using, and why I've been pointing to, like, probably not a bear market, guys. As crazy as it is, as unprecedented as it is, these things happen, man. These things happen. These are cycles. It just is what it is. It is what it is. Another thing I wanted to look at, this is KRE. So this is your regional bank index. Let me see the exact name. State Street Regional Banking ETF. All right, so this is just meant to show highly what is considered massively risky ETF. It's regional banks. These things are really susceptible to these credit crunches and liquidity crunches, as we've seen. When we did have massive crunches in liquidity, I mean, we had a bunch of bank failures come in. And if these things are pricing in, lower liquidity, we are going to know it and we are going to feel it. Okay, looking at the peaks in price here. Sorry, I can just take off momentum for now. But looking at the peak in price on these regional banking ETFs, I mean, just look what it coincides with: Bitcoin going into capitulation, Bitcoin going into capitulation. You could even do this one in here, Bitcoin going into capitulation as well. So hopefully you guys can see the connection that I'm making here. Hopefully I don't sound crazy. We can see when we look at rate of change, right? This thing is absolutely tweaked up. Okay. When we look at momentum, monthly time frame, just had a monthly close and it was massive, right? Massive. Nice up close there. When we look at the weekly time frame, nothing unhealthy at all. Little bit of an upside wick, but seems like it wants to kind of continue on higher here. And just in general, nothing to worry about, in my opinion. So what does that mean is happening in crypto? I mean, to me, it just means people are getting manipulated to absolute living hell. It just is what it is. We have all the dynamics in crypto. We have Bitcoin dominance where it needs to be. We have ETH BTC. We have all these things in play. We have all of these things in the freaking credit market, guys. The $1 trillion credit market. Like I said, maybe I'm crazy, maybe I'm going insane, but I feel like I've backed this up enough. Every single thing I show just hits and hits and hits and hits and hits. Every single cycle, every single time across any asset class. It's very hard to argue, in my opinion, but I don't want to get all worked up. Anywho, I'm going to go ahead and wrap it up here. I appreciate you guys as always. Let me know what you guys think about this stuff. I'll catch you in the next one. Peace.